Gold's decline since we started the Iran war, it was a much faster decline than the one that was triggered by the 2008 financial crisis. That's how sharp the decline was. In fact, last week was the worst week gold's had since 1983, so way before the '08 financial crisis. But if you look at the magnitude of the decline relative to the entire bull market, what we've already had in 3 weeks is about the same as what we had in 4 months of the financial crisis. But what's significant is after gold bottomed in November of 2008. Now, the stock market didn't bottom until like January, February, or March, I forget, of '09. The stock market fell another 22, 23% after gold bottomed. But after gold bottomed, within 3 years, it tripled. Gold went to 1,900. So if gold does the same thing again, has a 40% retracement, and then triples, gold's over 11,000. Now, I actually think gold's going to go a lot higher than that. I think the fundamentals are a lot better now than they were in 2011.
The recent plunge in gold prices has been breathtakingly fast, surpassing even the initial shockwaves of the 2008 financial crisis. In just 3 weeks, the market experienced a magnitude of decline that previously took 4 months to unfold, marking the sharpest single-week drop since 1983. Peter Schiff, a prominent economist and vocal advocate for sound money, points out that this severe 40% retracement is actually a massive historical buy signal. During the 2008 cycle, gold bottomed out months before the broader stock market and then proceeded to triple in value over the next 3 years. If that exact pattern repeats from current levels, gold is projected to blast past the $11,000 mark. With today's macroeconomic fundamentals looking vastly stronger for precious metals than they did in 2011, this aggressive pullback is simply shaking out the weak hands before a historic rally. Now we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This is ridiculous when it comes to gold. It shows you how liquidity-driven everything happens to be right now in this massive bubble that the Fed has inflated. Gold goes down when the war gets escalated, but it goes up when it gets de-escalated, which is the opposite of what you would think. You would think that when the war looks like it's going to be bigger and last longer and be more disruptive, you should want to buy gold. But if it looks like the war is over, you'd want to sell it. But the opposite is happening. The longer it looks like the war is going to continue, the more people are selling gold. I mean, if they declared peace tomorrow, the whole war is over, gold would soar. That doesn't even seem to make any sense. And, part of it, too, is linked to the idea that the longer the war continues, the longer we're going to have to wait for the Fed to cut rates. And that elongated wait for the rate cut, that's what's weighing on gold, which is irrelevant. Because the entire time the Fed is going to be on hold, inflation is going to be getting worse. And so real interest rates are going to keep going down, even if the Fed holds nominal interest rates the same. And, if inflation goes from 3% to 6%, that's better for gold than inflation staying where it is and the Fed cutting. Because what's important for gold is real interest rates. The nominal interest rates at the end of the day don't matter. Even if the Fed raises interest rates to 10%, if inflation is 30%, do 10% inflation interest rates matter? No, you're negative 20%. You would want to buy gold even more aggressively if we had 10% interest rates and 30% inflation. So it's the real rate that is important. And the traders still don't get this. Now, eventually, if the war goes on long enough, this is going to stop. At some point, gold is going to start to go up when the escalation goes up. But we haven't reached that point yet. But I think the pullback, if you look at the pullback to 4,100, that's about 40% retracement of the entire rally. If you measure the rally from the breakout at 2,000, right? That was really where we broke out. So we went from 2,000 to 5,600. A 40% retracement is about 4,100. Now, as we're talking now, and I'm going to get to why this happened, but gold's back above 4,500. So it's already bounced more than 10% from Monday morning's low. But that 40% retracement is exactly the decline that we got. The bull market in gold from 2001 to 2008, or that bull market where gold went from under 300 to 1,000, the 40% retracement there was about what we did in between August of 08 and like November of 08. During those 4 months, gold pulled back about 35%, which was a little bit bigger than the pullback that we've had so far, although this pullback was quicker. Gold's decline since we started the Iran war, it was a much faster decline than the one that was triggered by the 2008 financial crisis. That's how sharp the decline was. In fact, last week was the worst week gold's had since 1983. So way before the 08 financial crisis. But if you look at the magnitude of the decline relative to the entire bull market, what we've already had in 3 weeks is about the same as what we had in 4 months of the financial crisis. But what's significant is after gold bottomed in November of November 2008. Now, the stock market didn't bottom until like January, February, or March, I forget, of 09. The stock market fell another 22, 23% after gold bottomed. But after gold bottomed, within 3 years, it tripled. Gold went to 1,900. So if gold does the same thing again, has a 40% retracement, and then triples, gold's over 11,000. Now, I actually think gold's going to go a lot higher than that. I think the fundamentals are a lot better now than they were in 2011. So if gold could triple after a 40% retracement back then, it can certainly do at least that, if not more now, which is why everybody should take advantage of this decline and buy silver. In fact, silver went all the way down below 63. Remember, silver got to 121 or something like that. So almost about a 50% decline in silver from its peak. Not a retracement of the rally, but a complete 50% decline. Silver right now is about 71 and a half. So about $8 higher than it was Monday morning. So better than, again, 10% bounce off of those lows. But I think that it's nuts that we're at war and the fundamentals for gold and silver are better than they've ever been. They were great before the war. They're even better now that we have a war. And I don't care if the war is over. The war is damaging the U.S. economy. Yes, the longer it goes on, the more the damage is going to be. But there's going to be damage even after the war ends. When the war is over, it's not going to be a great thing that we're going to have. I think that Trump is going to promote it as this massive victory, no matter how badly we lose. And not that we lose in a military sense, that Iran defeats us. That's not going to happen. But we can lose in an economic sense. We can lose in a sense that we don't really accomplish anything. In fact, I think Iran knows, the Iranian leaders know, that they win the war just by surviving. If the regime is intact at the end of this, then they've won. Because they've stood up to the big American Satan, right? If they're still in power, even if it's different people, if it's the same basic regime, just different players, and who knows what they're going to demand. In fact, if you look, I'm jumping ahead of myself, so I don't even want to get to that.
The precious metals market is temporarily trapped in a liquidity-driven paradox where traders mistakenly sell gold during geopolitical escalation, falsely assuming delayed Fed rate cuts outweigh soaring inflation. This short-sighted focus on nominal rates completely ignores the reality that surging inflation continuously drives real interest rates deeper into negative territory, creating a massively bullish environment for tangible assets. The recent 40% retracement in gold, dropping from $5,600 to $4,100, perfectly mirrors the structural market shakeout of the 2008 financial crisis. Following that historical bottom, gold quickly tripled. With today's macroeconomic fundamentals severely weakened by prolonged conflict and unavoidable economic damage, a similar trajectory could realistically launch gold past $11,000. Furthermore, silver's aggressive 50% decline represents a generational accumulation window. Regardless of political theater, fiat currency debasement remains the permanent reality. Investors must ignore the short-term noise and secure physical assets before the next major surge. Let's get back to the interview.
Now, you have to ask yourself, if import-export prices rose that much in February, how much are they going to be up in March when oil prices jump 50%? The numbers could be much bigger in March. Now, what are the producers going to do? Because they're going to have to buy these imports, and that's going to mean their prices, their costs go way up. What are they going to do? Eat it? No, they're going to pass it on to the consumer. So all this is going to trickle down to the consumer. It's all going to show up in consumer prices. The number is going to be huge. Consumer price increases in 2026 will be the biggest jump since the 1 year, I think it'll be bigger than every year of the Biden administration, maybe except one, but even then it might be worse. 2026 could end up being a bigger increase in consumer prices than any individual calendar year under Biden, right? And Trump likes to say, we had the worst inflation ever under Biden. Well, it's going to be worse under Trump. And I think one of the reasons we may be at war is because maybe Trump realized that this was going to be the case even without the war. Had Trump not started a war, the inflation already in the system, baked in this cake, and he helped bake it with the big, beautiful bill with a massive increase in government spending that accompanied that and the rest of his economic policies. This is why inflation was going to go up. But by starting the war, now Trump has an excuse, something to blame the higher prices on. If the economy is in a recession, which it looked like it was going to be in one anyway, because the economy was weakening long before the war started, inflation was strengthening, the economy was weakening. Trump starts a war. Now we get the news later, months later, probably before the midterm election, inflation is high. The economy is weak. Unemployment is spiked. Now Trump is like, well, this is all because of the war. You can't blame me for this. I mean, I had no choice. We had to do this. We had to defeat the Iranians. They were about to nuke us or whatever. I had to do this. This is for freedom. And so this is just the sacrifice we all have to make. We all have to be willing to accept higher inflation because it's all transitory. It's all going to go away. As soon as we win this war, of course, everything is going to be great. It's going to be morning in America. It's going to be, the golden age. It's going to be a huge boom. It's just that we gotta just tough it up. This just happened like COVID, like something that just happened. We had no choice. We have to win this war at all costs, and so it's going to be worth it, right? He's got a scapegoat. Now he also has the Fed as a scapegoat. He's got the Supreme Court for knocking down his tariffs, but there's nothing like wagging the dog with this tail, right? And of course, it makes sense that Trump would do something like that because this is what he accused Obama of doing, even though Obama never actually did it. Trump repeatedly said that Obama will start a war with Iran as a distraction from his own failures, from the weakness in the economy. So he already in his mind thought that wars with Iran are good distractions for presidents that are dealing with weak economies. And so maybe he got the bad news from some of his people. Hey, things are getting bad. We're in a lot of trouble here. Inflation is going to spike up. The economy is going to tank. We got the midterms coming up. It's a good time to start a war. I don't know if this is what happened because I have no proof. I'm just saying that this is what's going to happen. And even if Trump did not deliberately start the war as a distraction, he will use it as an excuse. You better believe that the high inflation that we're going to experience, the economic weakness that we're going to experience is all going to be blamed on this war. Mark my words. Anyway,
the sudden spike in import and export costs, compounded by a massive 50% surge in oil prices, guarantees a brutal wave of consumer inflation in 2026. This severe economic deterioration was already structurally baked into the system through excessive government spending, long before any geopolitical conflict escalated. However, the current war serves as the ultimate political scapegoat. By shifting the blame for a weakening economy, skyrocketing prices, and rising unemployment onto foreign conflicts, political leaders can actively mask the underlying failures of their own fiscal policies. As inflation potentially reaches unprecedented highs this year, Protecting your purchasing power from these inevitable price hikes is absolutely critical before the reality of a prolonged recession sets in. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Thanks for watching.